Hi, everyone. Thank you so much for joining us today. This is the first of 6 sessions we're going to have covering the new bill. This one is broad, touches on a lot of topics, provides a pretty good overview of the bill. And then we're going to have more specific content coming out again. I believe it's every other week on Wednesday, same exact time, noon Eastern. Please register for as many of those as you'd like. We'd love to see you there. So in today's session, we're going to talk about, again, big picture legislation, what it means for you as a business, as an individual, talk about some key provisions and policy intent. So really quickly, I'd love to introduce our panel. We've got Marty Karaman. He is our tax credits and incentives expert. We've got Brian Dill, our international expert, and Sarah, who's an expert in many, many things, not the least of which is individuals and business taxation. So again, thanks for joining, and let's dive right in. So again, we're going to touch really quickly, overview of the bill, the process. We'll go into individual provisions, business provisions, then international, tax credits and incentives, and then just a little touch on expectations for guidance before we send you guys on your way. Okay, what is in the bill? The bill is a huge vehicle and it touches on more than tax, but tax is the primary driver and focus of this bill. It includes TCJA extensions, which is really the reason this bill had to happen in 2025, because we were facing a big cliff with many Tax Cuts and Jobs Act provisions ready to expire at the end of the calendar year. There's some new tax relief. There are some revenue raisers, which are usually taxpayer unfavorable, right? And those mostly come in the form of limitations on deductions. We have changes in the international tax regime, and we have a curtailment of certain IRA, Inflation Reduction Act incentives. Some of the provisions are permanent. Some of them are temporary. Many are permanent, but there is a little bit of a tax cliff that we've set up for 2028, 2029 for a number of these provisions, and we'll get into those. But by and large, the biggest chunk of TCJA provisions have been extended on a permanent basis. And I just want to mention right here, we're talking about this bill. This is the theme of the day, probably the theme of the rest of the calendar year. But I will say that there is already some discussion, particularly among Republican leadership, that there is interest in doing a second and even a third reconciliation bill over the next year or two. You can do one each year on revenue, one each year on spending, one each year on debt limit. Now, this bill, we have covered all three, but that is something that we're looking for. And there are a couple proposals floating out there for changes to the bill that just got passed, one of which is wagering losses, which I think Sarah will talk about in a little bit. But really quick on this bill, this is the largest bill in terms of cost of at least my career, right? TCJA cost total was $1.5 trillion. Now, again, a lot of this is a continuation of TCJA, but we're at $4.5 trillion of cost for the tax provisions, not the overall bill, because there are some revenue raisers in other areas, really Medicaid, a big one. But if you compare this bill against current law, which is current law was, well, I guess it was current law, it's not anymore, was set to have, these provisions expire, the cost of this is $4.5 trillion over 10 years. If you compare it against current policy, so if we were to assume that there was no TCJA expiration, it would be $715 billion. And that current policy, that is how the Senate successfully made many of these provisions permanent to work within the rules of reconciliation. It was a novel approach and it was a little bit risky, but it worked for them. So really quickly, overall, over 10 years, the Congressional Budget Office has estimated that the bill will increase the federal deficit by $3.4 trillion. And I think that's a lot of the reason we're hearing discussions of potential additional reconciliation bills is because there are a number of fiscal conservatives who aren't really happy with that figure, right? That they're very concerned about the fiscal trajectory of the United States. In addition, this bill increased the debt limit by $5 trillion. That should get the United States through the midterm elections. So we shouldn't have a big fight going into the midterms about the federal debt limit. So how did this come together? Well, it was fast and furious, I will say. It happened really quickly in terms of we saw the first passage with the House passing their version of the budget resolution on February 25th, final passage of the bill and signature on July 4th. The amount of time in there is 129 days, which is so fast if you think about the fact that it has $4.5 trillion of tax cuts, in addition to over $1 trillion of revenue raisers elsewhere. House passed their, you can see here really quickly, just sort of interesting politically how these come together. House passed their budget resolution. Senate took some time to pass their, to come up with their version of it. And then House passed that version pretty quickly after. House took some time to craft the bill. They crafted the bill. Senate sat with it a while. They crafted the bill, passed their bill almost immediately after the House passed the Senate version. Financial legislation begins in the House, and so this happens sometimes, and the Senate is obviously, it's the upper chamber, a smaller body where policymakers have longer terms. But what we saw here in this is that what the Senate was okay with is what got passed, both from a budget resolution perspective and in terms of the actual bill. An interesting fact, July 3rd is exactly 6 months after the 119th Congress began. It began on January 3rd. So it took them 6 months from the beginning of their session to pass this bill, which is, again, a very quick timeline from a historical perspective. So I would love to introduce, oh, sorry, we have a polling question. We do have more than 4 here. I think we've got 5 or 6 today. So please answer. Which of the following changes do you think will have the greatest impact on your tax provision? Business changes, international changes, energy changes, or other, which could be, right, individual, how it plays out on your 1040, or SALT changes, tax exempt, whatever is most relevant to you. We would love to know that. But while you're answering that, I would love to introduce my friend and colleague, Sarah. She's going to talk to you a little bit about the individual provisions. This was the, maybe not the most, exciting, but the largest portion of the bill, and really what drove the timing in the need to have this bill completed in 2025. So Sarah, I would love to kick it over to you.
So thank you, Casey. Yes, extending the Tax Cuts and Jobs Act, or TCJA, provisions that largely impacted a lot of individual returns was a paramount request and expectation of all the members of Congress, both in the House and the Senate. The House extended many things with some limitations on them and maybe some expirations. But then the Senate came through and made some permanent changes to a number of these provisions. So first off, tax brackets and rates. Tax Cuts and Jobs Act introduced 7 layers of tax brackets and rates, starting with a low of 10% and going as high as a max rate of 37%. This law now makes those brackets and rates permanent. Changed a little bit about how those brackets and how those brackets will change with inflation each year, but essentially we'll see a same rates going forward. When it comes to the standard deduction has been greatly expanded, and this new bill will now continue that expansion. So for 2026 and forward, the standard deduction for an individual filer, $15,750, and twice that for a married filing joint return. Itemized deductions, similarly, keep going with the way the rules were already written. We're already playing out. That is, miscellaneous itemized deductions are not allowed. The limitations on mortgage interest are still in play. The limitations on casualty loss deductions are still in play. They did make one change going forward, and that is unreimbursed educator expenses now becomes an itemized deduction. And that does get to be allowed as an itemized deductions, whereas other unreimbursed employee expenses are not allowed as a deduction on this return. Another benefit of TCJA that will be continued is alternative minimum tax thresholds. The exemption was increased significantly. Now it is going to come down a bit in 2026 to million, but the phase out of that $1 million exemption also is increased. It will phase out faster for higher income individuals. But that also is very fortunate, particularly as we talk about the change in the SALT cap in a few minutes. Child tax credit was going to reset back to a lower number. This bill has extended that again for 26 and forward, $2,200. Also, the higher refundable amount will continue as well. And for those that are going to hold off dying or making gifts until 2026, the lifetime exemption will be raised to $15 million and then indexed for inflation going forward from that. So we have more certainty about what happens in the estate and gift planning area now. There are some other areas that are temporary. These really apply 2025 through 2028. And these provisions fulfill a lot of the promises made by President Trump when he was out on the campaign trail. No tax on tips, up to $25,000 of reported tips, that is on a W-2, a 1099, or self-reported tips, can be excluded from income. No tax on overtime. This again is reported overtime income to employees, either through 1099 or W-2. And this, when you talk about no tax on overtime income, it's limited to $12,500 for an individual filer or $25,000 for a married filing joint return. In this case, think of the overtime pay is the and a half portion of time and a half. So it's going to be very complicated for employers to keep records and provide the right information to their employees on the amount of overtime pay that is eligible for this deduction. They were not able to, the Congress was not able to exempt Social Security from taxation. But in lieu of that, they did provide a $6,000 deduction for those age 65 and above. This is a deduction for each person that is over 65 years of age and older. It does phase out. All of these items have limitations and phase out points to them. So we'll see how successful that is, but it will not offset Social Security income. By and large, Social Security income is much larger. There was some misinformation provided from the Social Security Administration early on that, hey, Social Security income is no longer taxable. That is not correct. There is this deduction available for seniors. Another incentive that was dropped in was car loan interest that will be deductible. Right now, under current law, car loan interest would not have been deductible as that is personal interest, but there is going to be a period of time from 2025 tax year through 2028 when that may be deducted for some purchasers of new vehicles assembled in the United States. Some other changes that are important to many people, the one that got the most discussion and the most arguments and the most negotiation was the SALT cap limit. That is the amount of state and local tax that may be deducted for those that are itemized deductions. And for a period of time, that is going to increase from $10,000 to $40,000. And that begins this year in 2025. It does end and go back to a 10,000 limit for tax year 2030. But at least for a time, we have this increased limitation on the amount of state and local taxes that can be deducted. Again, there is a phase out on this for incomes at $500,000 and above that will reduce the SALT cap limit down to no more than the $10,000. So everybody will get at least the $10,000 cap. Those that are under the $500,000 or have not phased out completely will get more than that. The limitations on itemized deductions, this is something new. The old PEAS limitation, which had a 3% of AGI reduction of itemized deductions, is out. For those that are in the highest tax bracket and above, there will be a 2/37 phase down of itemized deductions, which essentially means that for those individuals affected by this, the You will not get a 37 cents on the dollar benefit for an itemized deduction. You will only get a 35 cents on the dollar benefit for itemized deductions. A couple of changes to charitable contributions. The bill reintroduced an above the line deduction for non-itemizers, $1,000 for an individual return, $2,000 for a married filing joint return. Also introduced a 0.5% floor for itemized for charitable deductions for those that do itemize their deductions. That is, think of it like the 2% floor on miscellaneous itemized deductions or the 7.5% for medical expenses. Now there's a 0.5% floor for itemized deductions. A new provision that was added is for organizations that grant scholarships to a class or group or identified group of students. Individuals will be able to make a donation to this not-for-profit organization that makes scholarships and be allowed a dollar for dollar tax credit for against their federal taxes up to $1,700. So you could make a $1,700 contribution to the scholarship fund. You would not get a charitable contribution deduction for it, but you would instead be allowed to take $1,700 of tax credit on against your federal taxes. The limitation on wagering losses, I'll bring this one up before the Trump accounts. In this case, this one got a lot of attention, particularly immediately after the bill was passed. And the limitation on the wagering losses is that the wagering losses are limited to 90% of the total losses that an individual has. And then those wagering losses are still limited to the amount of winnings. So for someone who has more losses than winnings, this may not impact them so much. But for those whose winnings are greater than their losses or equal to their losses, then they're very likely going to be winding up paying some income tax on their net wagering income. And with the huge growth of sports betting and online gambling that's happened all across the country, this is likely to affect a lot of taxpayers in there. The Trump accounts is a new savings vehicle for children. Contributions will be able to be made into these accounts, $5,000 a year. The income is earned tax-free. The distributions come out to the individual. They can leave it in there until they retire if they want. A great savings vehicle to go forward. Employers can put in $2,500 for each account, and it doesn't count as wages to the employee. So another benefit to be considered going forward. I think, Casey, that's what I was going to cover. Did you have other items that you wanted to make note of as we bring up our second polling question?
No, I mean, just that some of these, right, are retroactive. The ones that are taxpayer favorable, or not all of them, but the ones that are retroactive are taxpayer favorable. Congress is not usually in the business of making retroactive taxpayer unfavorable. But some of those limitations, those begin as the year rolls over, January 1st. Some of these other provisions are effective in 2025. So when you go to file your 2025 return, which will be, nominally as early as, winter, spring 2026, you may see that. I mean, I think the hope is from the drafters that their taxpayers will see a positive impact on their tax liability. And I think that's by design, right? Going into the midterms. So I think there are, again, most of these provisions are taxpayer favorable. There are a couple of revenue raisers, but by and large, that's why the cost was so high, right? Because we're providing a myriad of tax breaks to all types of different taxpayers. So yeah, we can jump into the polling question. How do you believe the new SALT cap will impact your personal tax position? I won't itemize. I'll start itemizing. I'll continue itemizing, but with a larger SALT deduction, or I'll continue itemizing, but I expect to phase out of the new benefit. So thank you so much, Sarah. And then just again, I know we're going to talk about this a couple times, but in our series, there is a webinar coming up in a few weeks where we will talk more in depth about these, right? We'll get into a little bit more details, and this is certainly not an all-inclusive list of individual provisions, in 10, 12 minutes that we're able to cover. So yeah, thanks so much. We'll maybe jump into the business provisions. I just want to start out really quickly by mentioning there are some business provisions that got a lot of press that never made it into the bill. The 15% rate for manufacturers didn't make it. The corporate SALT cap, which was, unfavorable, didn't make it. And sort of in that same vein, through the bill, through the House version and then the initial Senate version, there were different limitations on what I call PTET, pass-through entity tax. And it's, sort of that provision that allows partnerships and S corps to pay the tax on behalf of their owners and take an entity level deduction, because after TCJA, right, we had that SALT cap before. We didn't have a SALT cap for individuals. And so that's something that came about 2018, 2019, and was sort of blessed by the IRS in 2020 with Notice 2020-75. Actually, we do expect potentially more guidance on that. We haven't received any more because it was maybe something that was going to phase out, maybe something that was going to change, but now it looks like it's probably here to stay. So a lot more to come on that. And again, we have a SALT webinar coming up as one of our items, but that didn't make it in. I think big breath of relief, right, from pass-through entity owners on PTET limit not making it in. And then there were some revenue raisers that President Trump was really excited about. 1061 carried interest limitation, and then sports franchise amortization. He really pushed for those. They did not make it into the final bill, just not enough support in Congress for that. Let's jump into some of the main business provisions. This is the trio of business provisions. They're also sometimes called the orphan provisions of Tax Cuts and Jobs Act. These are things that were in Tax Cuts and Jobs Act where the treatment changed, and it changed for two of them in 2022 and one of them in 2023, again, because they were trying to fit TCJA into the budget resolution that they had. They had certain numbers they had to hit. And so there were changes that happened that some of the drafters have come out and say, hey, we never intended those. We were hoping to correct those before they came into play, but they came into play. Taxpayers were affected. And this trio actually got a lot of action early in 2024, a lot of bipartisan support. There was a bill that passed the House very, very easily, margin of over 80%, that would have corrected these retroactively. Never made it anywhere in the Senate, but here we are. We've got them going forward, and they're permanent. So I think that's important. They're also not particularly, in my opinion, at risk for the future because they do enjoy a lot of bipartisan support, even if winds do change in Washington in the next election or one after that or one after that. So let's dig in really quickly. Bonus depreciation. This lets me deduct an asset when I purchase it, assets with a useful life of 20 years or less. So, if I've bought computer equipment, or a software program, I might put it into service, and the IRS says, hey, we think the normal useful life is 3 years, so we depreciate it over 3 years. This lets me take it all at once if I elect to, and you can elect every year. This is something you can examine and can change with your tax position. So that is permanent. There is a temporary provision that's kind of similar that we won't talk too much about because I know that Marty will get into it next week or 2 weeks in TCJA. But one is qualified production property. We're trying to increase manufacturing capacity inside the United States with this provision, and it will allow for the immediate expensing of a building, a 39-year asset under the right conditions. So again, won't talk too much about that, but something that's interesting. We've got research and experimental expenditures. The treatment for that changed in 2022. We went from being able to immediately deduct those to having to amortize them. And so you put them on the books, capitalize them, and then you amortized or deducted the domestic expenditures over 5 years or international expenditures over 15 years, which was not very popular, again, with policymakers, with businesses. And we saw that change for domestic expenditures in this. So going forward on a permanent basis, all domestic research and experimental expenditures, or R&E expenditures, are currently deductible. That being said, there is an option to capitalize if you would like. We won't get too much into that. For those expenses, right, 2022 through 2024, that have already been put on the books and we're in the middle of amortizing those, businesses have some options. They can keep going on the current path. They can deduct them over 1 year or 2 years, ratably, or there is an option for small businesses, those with under nominally 31 million in gross receipts, to go back and amend returns. That is a complex analysis, right? So that's something you want to work with your advisor on. That affects taxable income. There are a lot of things that come out from that, and we're going to spend a lot of time on that again in 2 weeks with Marty. And Marty will talk a little bit more about it in a bit too. So that's an important one. And then there's the business interest limitation. In 2022, we switched from being able to deduct 30% of ATI, adjusted taxable income, which was calculated based on EBITDA, earnings before income, taxes, depreciation, amortization, to just EBIT. So it was more restrictive. And it came at a time that interest rates were rising because the Fed was increasing rates to combat inflation. So that was really painful for some taxpayers. We have switched to the looser EBITDA. We still have the 30% limit, but it's a little bit lighter now. We are seeing at least the federal rate come down a tiny bit. It's holding at the moment, but it did come down a little bit. And then I think the hope is going forward, there will be reductions, whether they're this year or next year. And so we'll see a little bit of easing there, but that is a pain point, and this should provide some relief for a lot of taxpayers. These are permanent, and that makes, again, aside from the qualified production property, those factories, that makes decision-making easier for taxpayers, right? A couple other provisions here where we are talking about small businesses or pass-through businesses. For pass-through businesses, at TCJA, we got that 21% corporate rate, and that was the Wall Street rate. And then for Main Street, we got the 199A deduction, and that allows most, not all, but most taxpayers, if they're the right type of taxpayer and there's not too much money and they have enough employees and have enough assets, to deduct up to 20% of their taxable income. So if I make $100,000, I only have to pay tax on $80,000, right? And that is extended, and which is a positive thing. In addition, there's a phase-in range. We phase in to the limitation. The phase-in range has been expanded a little bit, by 50%. So there is some benefit there. Flow-through entities should continue to enjoy that benefit. There is a provision, excess business loss limitation, that came about with Tax Cuts and Jobs Act. And it basically said, I'm going to take all my business income on my 1040, right? All my business income from flow-throughs, all my business losses, I'm going to combine them. To the extent I net have a loss, I can only deduct a threshold amount. Everything in excess of that gets carried forward to next year and turns into an NOL. We've had that for several years now. For a while, we've seen proposals, and in both versions of the bill, not the final bill, but in both the House and Senate, we saw provisions that would subject that carry forward to retesting every year. So instead of really deferring, it would have become a permanent provision. That did not make it in the bill, again, much to the relief of many pass-through entity owners. Again, really quick, I don't have it listed here, but pass-through entity tax regime remains intact. None of the changes that were proposed made it through. A couple other things for small businesses. Section 179 business asset expensing has been expanded. It operates similar to bonus, allows you to deduct things immediately, but it has a few different functionalities, and it can also vary the treatment based on state levels. So that's an important one. And then Section 1202 qualified small business stock. This has been expanded. This allows you, when you have certain type of stock that qualifies, small business stock, to basically exclude the gain on the sale of the stock up to a certain amount. So it would be tax-free, but it was a 5-year holding period. If I held it for 4 years, 364 days, I got nothing. And if I held it for 5 years or 5 years and 1 day, I got everything. Now there's a tiered system. And so that makes it a lot more accessible to taxpayers. And so I think we're going to see some questions here. Hey, is that how I want to structure my new business? And, or if I have a qualifying pass-through business, is that something where I want to do a transaction conversion to take advantage of that? So I think that those are things worth discussing, especially if you're a small business. And then lastly, I just want to touch on really quickly a few community development provisions. The most impactful here is opportunity zones. So we had an opportunity zone program. It had sort of a limited, it set timeframes, right? This is when it expires. You would have to invest by this time to get this benefit, this time to get this benefit. This makes opportunity zones permanent. It has rolling 10-year designations, and the time frame is based on when you invest. So Marty, I think, was the first person to say to me, hey, OZs, which we call opportunity zones, OZs, are the new 1031 exchange. And they really sort of are. There's going to be a lot of opportunity for gain deferral, up to 5 years of gain deferral, in addition to sort of a reduction in the total gain you pay if you're investing in these opportunity zones. A lot more detail here, a lot more nuances. So again, look for more detail in a subsequent webinar, but I do think that's really interesting prospect for both business and individual taxpayers alike in terms of looking to defer gain and make new investments. Just really quickly, low income housing tax credit and new market tax credits. These were always expiring, one of these expiring provisions that's at the last minute renewed, or maybe even retroactively renewed. These are permanent, which is great. New markets tax credit remains permanent. Low income housing tax credit is permanent and got a little like 12% bump, a little permanent increase. So those are really, again, these are all taxpayer favorable provisions looking to incentivize people to invest in those communities, especially those in greatest need of, financial investment and rehabilitation. So with that, we'll do polling question 3. Which of the trio of tax provisions will have the greatest impact on your business? Bonus depreciation, research and experimental expenditures, or business interest limitation, or NA, I don't own a business.
Great. Casey, we had a couple of questions in the chat
Yes.
about the qualified scholarship funds and the credit. 2 things. There is something already in a number of states, like in Georgia, the Georgia Gold Fund. If there is a state tax credit allowed, then that is not going to also allow for a federal tax credit. So we may see some new funds set up or some changes made to the existing state funds.
Yeah.
Can it be associated with a college or university? Probably. They may be set up funds through the university or through an affiliated organization. We'll have to see. The states are the ones that are going to tell the IRS, hey, these are the qualifying organizations in our state that are providing benefits to students here. So we'll just have to see how the guidance comes out and how this plays out. But I expect to see a lot of activity in this area. And I would watch our not-for-profit team as they keep their eyes on this, since we have a big activity area in both not-for-profits and particularly colleges and universities and private schools and education.
Yeah, and we're going to do our best to answer any questions we can, but keep them coming because that'll inform some of the content we put on our subsequent webinars as well. So yeah, thank you
there
so
was
much.
another question about qualified small business stock. I would say hang on to that one until our business program, and they'll be
Yes.
talking about QSBS more in depthly.
Yeah, Barry will be all over that. You're going to love him. He's wonderful. Okay, well, with that, I would love to turn this over to Brian Dill, a man who knows so many things that are absolutely so relevant and confounding to me sometimes. But the international tax regime is ever evolving, and as we work in this global economy, and Brian has some wonderful insights here. So thank you so much. Brian, take it away.
Thanks, Casey. Really appreciate it. Before we get started, I think to talk about the new tax provisions for international, what's really important is what did not make it in to the final bill, and that's really Section 899, the retaliatory tax for foreign companies coming into the U.S. and having a global minimum tax in their home country. The U.S. agreed at the G7 that they would not if the G7 would remove global minimum taxes in that regime. So the bill, as it came out, we do not have a Section 899. What's really important to remember, though, and be cognizant of is no countries have implemented this agreement. So if you are a U.S. parented company at this point in time, you still have to comply with the foreign country global minimum tax rules. Secondarily is one thing that was not in the agreement and was a point of contention was the digital service taxes that'll be imposed by particular jurisdictions. That was not part of it, even though Section 899 was removed. So at this point, the US has taken the first move to remove Section 899. It's not in the bill, but at this point in time, we do not have actual implementation of the agreement at the other foreign country levels. We'll see how that plays out over the next 12 to 14 months, however. And as Casey mentioned, there are other bills that are looking to be imposed. So this could be something if they don't like what they're seeing on the global scale. This is something that I think could be reintroduced if it's not implemented. So let's get started really quickly. Key observations I think that is important is what we are seeing is really, and we'll talk a little bit about this, that with the new rules, really encouraging US investment over foreign investments. I'll talk about, the new GILTI rules and really what that is. It's a global minimum tax. So really what the US is saying, if you're going to be overseas, you're going to pay a global minimum tax on that through GILTI. And then through the new export regime, we'll talk a little bit about encouraging US exports and the benefits that can be there and who they apply to. And then there are several provisions from Trump 1.0 that, as Casey said, was with Trump 2.0 was done very quickly in 6 months. Well, the implementation of Trump 1.0 also went very quickly. And as you might expect, there were some particular rules that were not implemented in the most effective manner. And so there's some clarity now and some changes to those rules, I think, to, for the most part, achieve the initial objective. I think one big takeaway, we'll talk about this on every one of these next slides, is US entity choice is going to become very important. We will see that the benefits that are coming from the international provisions are really for C corporations. If you're doing business overseas through a flow through or individual, you really need to take a hard look and see if that makes the most sense given the way these new rules are going to play out. Next slide. So what do we have here from a GILTI provision? I think the important thing to remember about GILTI is they've changed the name, and the name doesn't have no meaning. I think the very important thing to think about, if this new net CFC tested income, the original GILTI was really under the pretense of, we do not want US companies through their foreign subsidiaries earning intangible income offshore and not paying sufficient tax. So it was a minimum tax on your intangible income earned overseas. And the US didn't like that. Trump 2.0 removes any pretense whatsoever that GILTI was all about intangible income. Really what it's about is imposing a minimum tax on your foreign income that is being earned through foreign subsidiaries. Now, these key takeaways that I mentioned here only apply to C corps. If you're an individual or pass-throughs up to individuals, these benefits under the new NCTI are not going to be applicable to you. You'll just get taxed at your ordinary rates. So key takeaways you all can read there. Really what's happening is the effective rate has gone from 10.5% up to 12.6%. I think that's very important. So they've raised the rate by decreasing the deduction. The other thing, and this is the important piece of intangible, is that the pretense of having a deemed rate of return on your tangible property offshore have gone away. They've erased that. You no longer get that deemed rate of return. So if you have income earned overseas in a foreign subsidiary, absent subpart F, it's likely going to be picked up as GILTI and subject to tax back here in the US unless there's a particular exception applies. The second thing that it happens is, one thing, the haircut. There was a foreign tax credit limitation haircut that was at 80% for C corps. It has now been moved up to 90%. So you get 90% of the foreign taxes that are paid on GILTI income. You get and are eligible for credits here in the US. Formerly, it was 80%. So that can play for companies that are paying foreign taxes in their foreign subsidiaries. The increase in the net effective rate might be offset by the foreign tax credit. Also, companies that are highly leveraged here in the US and have a lot of debt, the expense apportionment rules, you had US interest expense and you were taking those deductions. Well, that was formerly apportioned against your GILTI income and would reduce your ability to take the foreign tax credit. That rule has been changed. Those are no longer apportioned. You only apportion direct expenses. So that's why I say highly leveraged C corporations may yield more benefit from this legislation, even though there is a supposed net increase in the rate. With the foreign tax credit and the elimination of expense apportionments, I think we could really see some companies actually benefit from this new GILTI legislation. You just have to work through the numbers to see how it applies to you personally. Just remember 2025 is not included. So for 2025 tax year, it's the old rules. This does not start until 2026. Next slide. Foreign derived intangible income, a constant theme. They are eliminating the idea of intangible income and moving to no pretense. So global minimum tax via GILTI no longer associated with intangible income. And in the US, companies used to be disadvantaged if they were tangible asset heavy here in the US and did not get as much of a benefit from FDII. With the new foreign derived deduction eligible income, I think we could see tangible asset businesses actually yield more results from this regime compared to the old regime. So once again, moving away from the idea of earning intangible income offshore and taxing it here in the US to no, we're going to tax you as a minimum tax on your offshore income, and we're going to offer a larger benefit on your exports by changing the name. You can see the details. It's essentially the effective rate. The benefit has gone down a little bit. So the benefit has changed, but for tangible asset businesses, once again, QBI has been eliminated. So the tangible income reduction has been eliminated. Also, the expense apportionment clause like GILTI, that has been eliminated. So you have to work through the numbers, but I think tangible asset heavy businesses, people investing in new buildings, new assets, new machinery and exports, I think they can realize actually a larger benefit from this new regime compared to the old regime. Service companies, I think service companies will see an actual reduction unless the expense apportionment gives them the benefit. This is important. There's two things. The new regime starts in 2026, except some companies were exporting intangible property. They were selling copyrights. They were moving their intangibles offshore, and they were taking advantage of the old FDII. That is no longer available effective June 16th of 2025. So you can no longer export intangibles and take advantage of this regime. It's now excluded. And so they did catch that loophole and they closed that in the bill. Next. Other significant changes, and there are a lot, and I will try to go through these quickly. The alternative minimum tax, really, which is known as BEAT, base erosion anti-abuse tax for intercompany transfers, increased to 10.5% from 10%. Everyone was thinking that it would go to 12.5%. Some were thinking 14%. It eventually landed at 10.5%. This is one of the changes that was in the Senate bill that did not actually go through. There were a number of other changes in the Senate bill that would have made this even more prohibitive. Those got axed. So while the Senate bill largely carried over and was the final bill, BEAT was not one of those provisions. It kind of apes or maps more closely to the original House bill. For you international tax nerds, restoration of prohibition on downward attribution. What happened, just to give a quick history lesson, is in Trump 1.0, they eliminated downward attribution. They eliminated the restriction on downward attribution. And what happened is foreign parented companies that had a U.S. corporation, that U.S. corporation would be deemed to own all of the foreign corporations owned by the foreign parent. And if there was a U.S. investor in the foreign corporation and happened to be a U.S. shareholder, all of those foreign corporations would be CFCs, and they would have to pick up all the GILTI income. They would have to file 5471s. It has been just an absolute nightmare for companies, and it has caught a lot of taxpayers off guard. They weren't aware of it. So that has been eliminated. However, look at the next bullet point. They did correct it by adding a new 951 cap B. And so there is still CFC inclusions for foreign controlled US shareholders. It's a new downward attribution rule, kind of. I will not go into those details. When we go into the international section, we'll kind of draw up when that would be applicable to you or where you should think about those structures, especially foreign investors that have US investors inside of them. Something to look out for. Something that we are all happy here in the international community is the CFC look-through rule was made permanent. What that really is, if you were a US taxpayer or shareholder and you had controlled foreign corporations and you had a holding company, for example, and that holding company owned operating subsidiaries, under the normal rule, if that operating subsidiary made a dividend distribution, for example, up to the holding company, that would be subpart F income immediately subject to tax in the US. They kept extending a temporary look-through rule that you look through the dividend to the underlying operating company to get the exception. That has been permanently extended so that holding companies that have operating companies underneath them, those dividends, you get the look-through rule to the operating company, and we don't have traps for the unwary. It's a welcome thing. Repeal of the 1-month deferral election. It's exactly like it sounds like. Trying to go quickly here because I wanted to talk about modification of the CFC pro rata share rules. I think that's an important change to the rules. So what happened, and this especially came up on acquisitions and disposition events, and people would be very surprised. So if I were a US company and had a bunch of CFCs and I were to sell those CFCs, my foreign group, to another US taxpayer, for example, and let's say I did it on July 31st, all of the GILTI income would be included in the buyers, the US taxpayer, the acquirers' tax return, not mine, the seller, because it's who owned the CFCs on the last day of the year. So that caught a lot of people off guard. There were some weird ways people tried to accomplish cutoffs, but it's a welcome change that now the seller will pick up their pro rata share for their year. So through July 31st in my example, and then for the remainder of the year, the acquirer will pick up their pro rata share of the GILTI rules, the GILTI inclusion. A welcome change that people were often surprised that they were having to pick up whole years of GILTI income, excuse me, for things. And it was especially surprising for deals that were closed in December and you only owned the company for 15 days and found out that I had a whole year of results that got picked up. We did see some surprises from that were not properly negotiated. Another thing is there's been some changes to the inventory sourcing rules. And those changes are that inventory will change there based upon title transfers a little bit. And so up to 50% of the sales income may be treated as foreign source income. That's a change in the rules. So this overrides the general rule of 863B that was in Trump 1.0, which would otherwise essentially treat all of those inventory sales as as US source. So for those foreign source sales of inventory, where you had especially foreign taxes incurred, then you may be able to get foreign tax credits for this. It's very, very welcome change in the industry for that. And hopefully that'll have some benefits for certain taxpayers.
Yeah, thank you. Thank you so much, Brian. I think we're hopping over to our polling question here. How are recent international tax changes affecting your offshore investment plans? We're slowly reducing activity, we're accelerating activity, no expected impact, or still evaluating the potential effects. And again, we are going to have Brian give us a whole hour on international coming up here soon. So if you enjoyed that, and which I know many of you did, please go ahead and register for that. But as we close out this polling question, let's kick it over to Marty for tax credits and incentives. He's also 174 and he's also bonus. So he wears a lot of hats here for a lot of provisions that are really hot right now. So Marty.
Thank you, Casey. And I have about 8, 9 minutes left. And I promise all of you, you will feel like it's an hour by the time I'm done. Anyway, with that said, I'm going to talk about the biggest deal in my life right now going on. Although we have many things going on in tax credits, incentives, advisory within the firm here. But let's talk about R&D and research R&E, shall we know, research and experimentation. Casey alluded to it back in 2022. Companies that had any software development, whether it be foreign or domestic, or research and development / research and experimentation, those expenses, say, for example, paid to somebody who was performing R&D, were no longer currently deductible. They had to become capitalizable and then amortizable either over 5 or 15 years, whether it's domestic or foreign. So what happened in the Senate version that ultimately passed and through the House and then was signed is that the R&D rules very similarly went back to kind of the way they were, for the most part, in pre-2022 years from a credit perspective. And what happens now is you can claim a credit, you can deduct the expenses as well. You have to reduce the expenses deducted by the amount of the credit again, which you didn't have to do during those 22 through 24 tax years. But you now, I think a lot of companies kind of shied away from like sort of tipping their hand that they had R&D in some cases, but without fear, you can go back and relook at, I would say, 22 through 24 and evaluate the true amount of R&D that may have been there from a credit perspective. And to the extent you have this capitalized R&D that is domestic, you can consider, if you are a company of, on average, 31 million or less in gross receipts, whether you want to take it all in 25 or 26, or go back and amend returns and get a kind of like refunds for that time back then. Let's go to the next slide, and I'll talk through some of the pros and cons around this. Invariably, right now, considering the fact that there is now a catch-up provision in 25 to accelerate your amortization, and for smaller companies, the ability to go back and amend, well, what should I do, right? And there's a pro, like let's say, for example, we haven't filed a return yet. It's 2024. What do? I think the simplest answer is we continue to follow the rules as they are. We capitalize. It aligns with sort of the legislation as it is. We don't have to go back and file amended returns. We also get to keep the gross credits that we calculated in 22 through 24. They're not tax affected. And then in 2025, we can accelerate all that amortization that we didn't take. It does delay that expensing, shall we say, until 25. And you can split it between 25 and 26 if you want. You can sort of evaluate your own individual situation and try to figure out exactly if you have expiring, shall we say, credit attributes, things like that, that you may want to not have all the expense going to one particular year. With that said, I keep getting approached by companies that say, well, look, this thing isn't going to be, no one has to capitalize anymore theoretically going forward, and we're going to have like a catch-up provision. Why don't we just not capitalize in 2024 and start now? Unfortunately, the law isn't written that way. And while you do have the ability to go back and amend, and so if you were to go back and amend 22, it's sort of a deemed change in accounting method, but there still isn't any guidance in terms of how you actually make that election to go back. So we're in a little bit of a wait and see, unfortunately, as we approach this 2024 filing deadline as late as October 15th. But it's not the worst problem to have. I think 3-4 weeks ago, when I saw what came out of the House, that there was no retroactive component to this, this is a much better place. So let's sort of all take a breath and like think about how good we have it right now compared to what it could have been, and not freak out too much in terms of like what we need to do right now. I think if you were counting on not having to, you kind of have to capitalize in 24, and you're in 25, you were kind of ready for it anyway. I would, again, to most in a vacuum people, suggest that you wait until 2025 to accelerate all that amortization. It's much simpler. Nevertheless, we are monitoring what's going on from a guidance perspective, and what the timing may be in terms of when that comes out, what we need to do to elect in order to go back to 22 and amend in order to set us up on a different accounting method for 2024 before we file in say October 15th or September 15th. It's a fun summer anyway, but we're going to watch that stuff, and it is allowing me to have a lot of conversations with clients about many. It's all good stuff. It's no longer like this is a bad thing. So this is really good stuff. And by the way, I'm just an advertisement for the 30th, because we're going to have some more stuff. We're going to talk about this in depth, along with examples of when it makes sense to potentially go back and amend. Say, for example, you're in a position when you sold the business or something like that. We want to think about all these different iterations. Most importantly, Casey alluded to it earlier, don't just make a decision without talking to somebody. Talk to us. We're more than happy to. I'm very lonely. I need the time. I'm happy to have any discussion with anybody. But let's move on to some of the other stuff really quickly in the next slides. Polling question. Okay. Would you like Cherry Beckett's R&D to help you maximize your 2025 benefit or explore amended return options? I'm hoping the answer is yes. If the answer is no, I'm hoping that it's because we're already doing that. Anyway, nevertheless, if you have any R&D that's there, you're going to want to have that evaluation done. And we have a whole team that does nothing other than really take a look at that particular position and see what makes sense. Inflation Reduction Act. By the way, I will get this done in 3 minutes. Really quickly, though, we're going to talk as well on the 30th about the bonus depreciation and the qualified production property changes that went into and will go into our cost segregation studies. And then also something else that happened on the, we'll call it real estate and construction, but associated with Inflation Reduction Act here is the 179D energy efficient commercial building deduction seems to be being phased out. And so we're going to talk about that and the timing that you have to get into that. I think it's a very valuable incentive. Right here, you can see these are the credits that are kind of gone, like by the end of this year or even earlier than that. These tend to focus on these individual provisions right here, where it's about EVs and clean vehicles, energy efficient home improvement property. We don't do a lot of it here that much, but they do affect the individuals, and those are primarily gone. And I think those were really politically charged issues, and you saw a lot of talk about that. So these are the ones that I thought were going to be gone, and they clearly were. Let's move to the next slide. Here's the thing, and what has happened, there were provisions under the Inflation Reduction Act around transferability of credits. It seems the transferability provisions remained for the most part, but some of the credits, specifically around wind and solar, were pulled back. And so the timing of when you have to begin construction and when you need to place things in service have changed for some of the wind and solar stuff, which I'll talk about on the next slide. The other thing that happened as well is this foreign entity of concern rules. There's a lot of focus on who's benefiting from those credits, where you're buying some of the components that go into it, and also who's benefiting from these credits. Is there an associated, call it like Chinese entity or other foreign entity of concern? There are very detailed rules around how credits are restricted when that happens. Let's go to the next one, and then we'll be done in a second. Okay, big point here. Biggest ones, solar and wind. To the extent you begin construction by July 4th, 2026, you have 4 years to get it in place. If you don't begin construction by then, you have only until 12/31/27 under the new technology neutral credits specific to wind and solar. Right here is an entire list of everything and some of the changes that have been there. We're going to hit each one of those in detail, and there's quite a bit. David Moamani on my team has spent a lot of time with Casey going back and forth with this. There is so much nuance here that I think it'll be interesting to you, but it doesn't have to be right now. With that said, we're going to end, and thank you all.
Yeah, let me really quickly wrap up. We'll cover implementation expectations some other time, but just so you know, we've got the statute. We don't necessarily have the guidance yet. It will come in drips, it will come in different forms. There will be a prioritization of those things that are retroactive, right? We're looking probably for some 174 guidance here quickly. Some of the other things that don't take effect till 2026, we're going to get more details on later in the process. State conformity is going to be huge. I really encourage you guys to dial into the SALT one that we do. States have to run a net neutral budget. So we're going to have some special legislative sessions here as states decide whether they can or cannot conform with the new law or whether they need to decouple in order to preserve revenues. But we're going to talk about all of these in our upcoming webinars. Here is our lineup. Please scan the QR code or go to our website. They're all listed. We look forward to seeing you at every single one of them, or as many as you can make, or whatever is relevant for you. Thank you again for joining us. Reach out with any questions. We are always here to help. Marty needs friends. That's what he told me earlier. So anything you need, just reach out to us. Thank you so much for joining. We will see you in 2 weeks.
Thank you.